What is one economic trend that you think Iowa businesses should watch? And we are going to go ahead and start that today with Debbie Durham. Debbie, go ahead and take it away.
Well, good afternoon, everyone. And Carla, your words were simply inspiring. So I don't know if you could see, but I was doing a lot of applauding for you. And thank you, Chris, and the Business Record for hosting this conversation. I too actually am anxious to hear from the other panelists. And Ernie, I don't know if you know this, but I am a big fan and follower of yours. So you saw my written response to this question. And though I recognize the challenges of navigating 2020, both personally and professionally, I am extremely optimistic of what we see in 2021 on a variety of reasons that we'll discuss further. And of course, Chris, I'm sorry, but I'm going to break the rule. I don't do anything in once. It's never about one, right? But I'm going to highlight just a few trends that I'm seeing right now that I think will kind of set the context for what we're going to talk about. Iowa and many of our counties today is already at full employment back. In fact, they're at levels prior to or before COVID, and many of them see that within reach. The other thing is that our manufacturing sector at the SME level, that supply chain, small and medium size, are really seeing a strong growth in orders. In fact, I had a CEO tell me the other day, they've got the executive leadership team working on Saturdays on the floor, if you can imagine that. And she said, for the first time, we're thinking of firing customers because that's where they are. And then Iowa is also has a fiscal, our fiscal house is in order. We also have a record of strength. And when other states are talking about how they're paying their bills and taking care of contingent liabilities, Iowa's actually looking at how we can be more competitive. So I also want to just state that the Council of State Government and KPMG said this about Iowa. Iowa is ranked number one, having the lowest risk of pandemic impacting our economy and having the highest resiliency to repair our economy after the pandemic ends. So again, uncertainty is always with us and it's always a factor. So if I had to say the but for, because I always do that, optimistic but, I would say that with all the talk of the new administration of coming together and working together, I'm extremely concerned about this executive legislation by executive order. And it also, a lot of our recovery is going to depend on the supply and the distribution of vaccines so that we can start building confidence at that consumer facing business level and get people out. And yes, Chris, I with you am also interesting to see the stock market look more like a gaming floor today. So with that, that's what I have to open with. Thank you.
Thank you, Debbie. And I know you're not a rule follower. That's why I only say one trend because I know you're going to give three. So Amy, why don't we have you go next?
Sure, thanks. Appreciate all the comments and appreciate the opening. And just want to kind of give you a little background. One of the things, so my day job is to run the insurance businesses for Principal. And so I certainly got to keep track of a bunch of employees, got to keep track of a bunch of trends in terms of interest rates. And certainly the pandemic is interesting when you're running an insurance business. But the thing that I do as kind of a side job is also keep track of the well-being index, which is the small business kind of sentiment index. Certainly, Creighton does a massively important job in the work they do in terms of finding economic indicators. But what we're looking for is really kind of sentiment. So that's where I'm going to kind of hone in on my answer is we probably need to watch not just the broader trends like unemployment and things like that and access to funding, but we need to watch job and wage growth and how sentiment is varying among metro and rural, and how sentiment is varying among industry verticals. And so what I see right now for 2021 is a whole bunch of uneven sets of recovery. I see some areas that are at literal all-time highs in terms of what they're saying they think they can do in 21, and I see some areas that are at literal all-time lows. One of the things maybe we can get into a little bit later is we had not been seeing that uneven sentiment between rural and metro areas. And that uneven sentiment is an interesting complexity for the Midwest and probably Iowa in particular. So we can come back to that at some point and talk about that a little bit. But I would watch rural sentiment, rural recovery, rural hiring as an indicator for stability for the whole region.
Thank you, Amy. Ernie, we're going to go ahead to you next.
Okay, thanks, Chris, and thanks to the Business Record and Raymond James and True North for their support of this. And thank you, Debbie, for your kind remarks. And Amy, thank you for taking such great care of my small 457 plan. You've done, your organization's done a great job with that. So thank you. And we do 2 surveys here at Creighton University each month, and both those surveys include Iowa. And what we're seeing, and it's pretty clear, just like Debbie said, the manufacturing sector is doing just fine. We're seeing some really good growth there. We're seeing our survey of bank CEOs in rural areas of 10 states, which also includes Iowa. And interestingly, we are seeing now farmland price growth that we haven't seen since 2013 and 14. So what's fueling this, of course, to a large degree, is good exports for Iowa, good I think economic development policies that have been very good for the state. But also we've got a federal government that's got the pedal to the metal, meaning they're spending like I was in the Navy, so forgive me for saying this, like a drunken sailor. And and we've had the Federal Reserve also supporting growth with policies that are unparalleled. We're seeing zero rate on the federal funds rate. We're seeing the Federal Reserve increasing their purchases of bonds in the bond market up to about $7.5 trillion. Now, what has this done, and what has it done for Iowa? Well, it's really reduced the value of the dollar. Since the pandemic, the value of the dollar has come down 10%. 10%. Now, what has that done for the Iowa economy, and for that matter, the U.S. economy, but more the Iowa economy than the U.S. economy, is it supported growth in manufacturing. We're seeing really good numbers in manufacturing. I expect that to continue. I think 2021 is going to be very good for Iowa. Why? Because I don't see any, I think the federal government and the Federal Reserve will keep their foot on the gas pedal. The problem I see, and what you asked Chris about what indicator we should watch, keep an eye on the 10-year Treasury. That's a better indicator than Ernie Goss can ever provide you. A yield on that 10-year Treasury is up 50 basis points, 0.5% in the last several months. Now, what is that telling us? It's telling us inflation is ticking upward. So we're going to see 2021 be very good for the economy, but how could you not be good for the economy when the federal government is going to run a deficit this year of $3 to $4 trillion. 3 to 4 trillion, that's with a T. And that, of course, is going to push up inflation in my judgment. It's already, the untold story right now is the inflation rate is now up to about 4% on an annual basis. Now that's only over the last several months. Well, what that's going to mean is those long-term interest rates will tick up already. Short-term interest rates, the Federal Reserve is committed to keeping them low until 2023. Well, Jerome Powell, you're not gonna make it. We're gonna see that tick up early. So my advice now, if your bankers are lending, be borrowing. And our survey of bank CEOs in Iowa, the number one concern they have is loan demand. In other words, they fear that the farmers are so positive and things have turned upward for the farms in Iowa. Now, unfortunately, it's not the entire rural economy. We've got, as Amy was saying, there is and Debbie as well, there is an issue here about the rural areas where you've got a leisure and hospitality. That would include hotels, restaurants, and taverns, and retail included, which are not doing very well. So we've got really solid growth, but in some of the areas outside of farming in the rural areas, not doing as well. In the metro areas, we're seeing good growth. What we're going to see this year, in my judgment, now this number may not mean much to the non-economists, but we're talking about 3.5% to 4% growth. That's much better than what we saw last year. It's much better. And what you tack on inflation on top of that, you're talking about as much as 7% growth in nominal terms. So look out for higher inflation, look out for higher interest rates, but growth will be very solid for the state of Iowa for 2021.
Thanks, Ernie. And I think I know it. I hope to come back just a little bit to the thing that you rose with the amount of money that's being injected in and what some of those long-term impacts are. Because I know right now this year's economic forecast, I think a lot of people are focused in on the immediacy, but I do at some point want to come back to that. So I've got it flagged. Scott, why don't we go ahead with you next?
Sure. My role here at Raymond James is to really look at everything in the economy. So obviously there's a focus on jobs, on policy, both monetary policy and fiscal policy. We have a new administration, who is pushing for another round of fiscal support. I don't necessarily think that we're going to get there. The majorities in the House and Senate are about as narrow as they can get. In fact, it's 50-50 in the Senate with the vice president as a tiebreaker. But when you boil it all down, it still comes down to the virus, and not just the infection rates, but sort of the impact that it's had on the economy and the effect that we expect to see in the economy once the virus is behind us. We have some concerns about distribution of vaccines, obviously, right now. We have a little bit of fear about these new mutations that are arriving in the US that could make the vaccines less effective. That's, I think, probably a low probability event that we really need to worry about, but it's something on our radar here. Ultimately, when you look at what's happened to the economy because of the virus, you had a huge lockdown, obviously, in March and April, where everything shut down. And then you had a very sharp rebound in May, June, July, which the things that could recover did. But it was a partial recovery, and it still left us far short of where we were at the end of last year. We just had GDP numbers released this morning, 4% annual rate for the fourth quarter of last year, right about as expected. And then you start slicing and dicing the numbers, and you see, some of the strength obviously continuing from the summer into the early fall. But then the holiday shopping season took a pretty big hit because people couldn't go out and buy stuff. You can mail order stuff, and that helped in terms of holiday sales. But those holiday sales, holiday travel were a lot less than usual. As vaccines are distributed, we expect to see a pretty big rebound in consumer services, which was the area that was hardest hit. Basically anything where you're in close contact with other people. So restaurants, tourism, travel, particularly important here in Florida. And as the virus recedes, we expect to see a pretty huge rebound in a lot of these areas. I think one of the lessons from the 1918 pandemic was that people sort of went nuts afterwards. I mean, you had the roaring 20s, and part of that was because people had been cooped up because of the pandemic back then, 100 years ago. So we're optimistic that the economy will pick up. In the near term, things are looking, pretty shaky. Obviously, the virus is still very much out there, and you've had state lockdowns and so on, restricting growth. But there also may be some long-term repercussions, particularly in the housing sector. I think many firms have found it easier to work from home, and if you can work from home, you can pretty much work anywhere. So, you can get a New York City job in Iowa. I mean, that is a possibility. And we're hearing from a lot of firms that they are, in terms of their hiring, they're casting a wider net now. So you don't have to look for employees within a local area. You can look all around the country. So some of those changes, I think, are going to be long lasting. We can talk about inflation, and we'll get into it, I think, a little bit more down the line, but I'm not really expecting to see a huge uptick in inflation. So that's sort of the basic view.
All right. I told the panelists that it was okay to disagree, so I'm sure we'll come back to inflation a little bit in the future. So Will, that leaves you. Why don't you go ahead next? And Will, we got you on mute there. There you go.
Yep. Thank you. So, I appreciate being here, and I had the privilege to move to Des Moines this summer. So I'll tell you one thing is maybe moving during a pandemic may not be the brightest thing anybody ever did, but it turned out well, and I've enjoyed it, and I'm loving Des Moines so far. I come at this question from my background in the banking sector. And when we look back to the prior recession in 2007 and 8, the banks, and especially the big banks, were in a lot of trouble, and the credit markets were having trouble as a result of the housing markets and the investments that were created on there. And really, it couldn't be probably further from the case this time, where banks are really in a solid, strong position. And we've heard a little bit about that in the prior earlier comments, but we see businesses and consumers having a huge demand for cash and leaving money in the banks. In fact, nationwide savings deposits have grown almost $2 trillion. And as people are a little bit concerned about the future and want to have access to cash and not sure what to do, that's left money in the banks. And it also leaves the banks with a strong position. So they are, I think one thing that we can watch in that sector to get a gauge on confidence is maybe changes in those savings rates, changes in deposit balance growth overall in the banking sector would presage a little different thought of confidence in the consumers and able to and see where they're going with that. I think what in this environment, what we see with the amount of money and liquidity that's come to the banking sector is as that confidence turns around, the banking is not going to be a constraint on growth. Rather, it should be ready to support and invest in communities and businesses that have a decent story to tell and a good credit profile, and should be able to help us accelerate out of this environment as things start to turn.